$100 a day. Google it and you'll find an indicator, a strategy, or a magic money button. $3,000 a month, $36,000 a year. And this figure kills more deposits than any bear market ever could. Let's figure out why $100 a day turns your life into a living hell. Today, we're gonna go on a quest. We have a trading account with $50,000. The goal is to reach a stable $100 a day. And ahead of us are 6 situations where you will have to make a decision. Every right choice brings you closer to the goal, and every wrong one to becoming part of the statistics. The one where 97% of traders are in the red? Let's see which side you are actually on. So, it's day 1. You opened the terminal, looked at the charts, analyzed them, and realized you don't have a clear entry point. The market, for example, is flat, and there's absolutely no movement there. But in your head, you still have that figure that you should be earning $100 a day. And you haven't earned anything today, so you've moved exactly this much closer to your goal. Now, here is the first question. It's morning, you have absolutely no setup, so what will you do?
Option A, I open a trade anyway. I need to make money today. Option B, I wait until noon, but if there's nothing, I trade with what I have. Option C, I don't trade. No setup, no trade. Option D, I switch the time frame. Maybe there'll be a signal on the 5-minute chart.
The correct answer is answer C. Now, I'll explain to you why. The other options are a 100% path to losing it all. Option A is the choice of the majority. The thought is, I have to make money today. But the point is, the market doesn't care what you think you owe yourself. If you enter without a reason, you're not a trader, you're a roulette player. Option B is a clever trap. Seems like you're waiting, but you've already decided you're gonna open a trade anyway. And that's not what you'd call patience. It's a kind of delayed impulsiveness that won't bring you anything good in trading. In option D, where you look for a signal where there is none, you switch time frames not because you see an idea, but because you just want to see it. The brain will always find a pattern in anything if it really needs to. A day without trades is not a failure. It's the best result you can get when the market isn't giving you anything. Successful traders can go several days without trading, and that's absolutely normal. And now day 2 has arrived. You waited for a setup, entered a trade, set a stop loss, and the stop was hit. Minus $250. And now you're in the red. The figure $100 a day now sounds like a mockery, because now you need to make not just $100, but $250 just to break even. Plus another 100 on top, so that makes $350 for the day. And so now I'm asking you the second question. Your stop was triggered, and you down $250 on your balance. What are you gonna do?
Option A, I open a new trade with a larger volume. I need to recover my losses. Option B, I record the trade in my journal, analyze it, and look for the next setup. Option C, I set a limit. One more stop and I'm done for today. Option D, I take a break until tomorrow.
The correct answer is C. Another good answer is B, but the others will lead to a huge problem. Let's break it down. Option A involves something called revenge trading, and it's the most destructive emotion in trading. You increase your volume to try and win back your position, but if the second stop is also triggered, now you're not just down $250, but say $700. By the evening, you could already be down $1,500. And just like that, one bad day can turn your whole life into a catastrophe. Option D might seem reasonable, but quitting after just one stop is way too early. One stop is a normal part of trading. You're not tilted yet, you just keep on working. Your best strategy would be to record this trade in your trading journal, which you must keep, analyze it, and give yourself one more shot, but with a clear rule. If you hit 2 stop losses in a row, then you stop trading. for the day. It's sort of like a two-strike rule. It protects you from overtrading and from that very revenge I mentioned at the very beginning. Now let's say it's the third day. You're sitting there analyzing the chart, and then a message pops up on Telegram. A friend sends a screenshot from a private channel. It says, for example, that we're short in Bitcoin right now, target minus 5%, everyone get in. In the comments, dozens of people are writing like, yeah, I'm in, I jumped in, thanks for the signal, but nobody knows what happens next. For instance, you didn't have a plan for that specific short yourself. Your analysis didn't show it at all. But since everyone's getting in, why shouldn't I? After all, it's a well-known channel, and that $100 for the day hasn't been made yet. The next question arises. A friend sends you a signal from a Telegram channel. Absolutely everyone's following it. What are you going to do?
Option A. I go in. The channel's reliable. People are making money. Option B. I enter, but with the minimum volume. I'll check it out. Option C. I open the chart and do my own analysis. If it matches, I go in. If not, then I don't. Option D. I ignore it. Other people's signals aren't my strategy.
The correct answer to this question is C. D is good. The others will be a trap. In option A, you're using blind trust. You don't know on what basis this signal was given. You don't know the author's stop, position size, or capital. You just see that everyone's in, everyone's getting in, so you think you should too. You don't see those who got in last time and lost. And there could be a huge number of them. Now here's the most important thing. Telegram channels work just like social media does. You only see the ones who made money. Those who lost money stay silent. They delete the app. They don't post minus $200 thanks for the signal. So you get this idea in your head that this Telegram channel is always right. But that's not true. By the way, we have a separate video on this, which you can find right around here. In option B, you decided to go in small just to test it out. And that sounds harmless enough. But you entered based on someone else's setup, not your own. Even if you profit, you're reinforcing the habit of trading on others' decisions. Next time, you'll go in with a full position, which could lead to trouble. Option D is completely radical, but it actually works. If you have your own strategy and you follow it, you simply don't need outside signals. The best option, however, is answer C. Look at the signal, open the chart, and verify it with your own analysis. Does it actually match up with reality? Enter strictly according to your own rules, with your own stop loss. If your analysis doesn't match the signal, then you just pass it by. In this case, you aren't ignoring information, but the decision is still yours to make. Day 4 arrives and it's finally a good one. Your setup was solid, you entered, and the market moved in your favor. And you see plus $300 on the screen. That's more than your daily goal of $100 a day. You'll likely feel absolutely euphoric, desperately wanting even more. You're in the flow, you're completely pumped up, and you're itching to open another trade because you've already decided today is definitely going to be your big day. But before we dive into that, let me ask you the next question. You're up by $300. What are you going to do next?
Option A. I open another trade. Today is my day. I need to make the most of it. Option B. I lock in my profit. I close the terminal. Option C. I leave the position open. I move my take profit higher. Let it grow. Option D. I open another trade, but with half the volume.
The only correct answer here is B. And here's why. Euphoria after a profit is the mirror image of revenge after a loss. It's the same emotions, the same loss of control, just with a different sign. In option A, greed is what we're dealing with. You've already earned 3 times more than the norm. One extra trade could not only wipe out those $300, but pull you into the red. Just stick to your trading plan, and everything will be just fine. In option C, where you chose for the asset to keep growing, it's reasonable, but you're already mentally spending profit that doesn't exist yet. And if the market turns, you'll lose not just money, but your mindset, which is essential in trading. In option D, we have a compromise. It's not perfect, but it's acceptable. If you really do have a setup, you can try it with reduced risk. But the best option in this whole situation is to just take the $300, close the terminal, and go live your life. Touch some grass, because tomorrow you might be in the red. And then this $300 cushion with $200 extra could be what saves you. Consistent traders have a very important skill that you'll need to learn. And that skill is knowing when to take your winnings. And now we've reached Wild Friday. The end of the trading week, you're tallying the results. On Monday, you earned $0. On Tuesday, you're down $250. On Wednesday, you're at zero again. On Thursday, you're up $300. And on Friday, say, down $20. So for the week, you've earned a total of $30. Not the $500 we originally expected, but just $30. You worked 5 days, analyzed, waited, were patient, and the result is less than the cost of a dinner out. Inside, you feel disappointment, a sense that you're just spinning your wheels. Let me ask you the next question. At the end of the week, you're up $30. And how do you feel about that?
Option A. This is bad. I need to change my strategy. This isn't working. Option B. It's fine. I didn't break any rules. The week is in the green. I keep going. Option C. I need to increase my trade volume, otherwise I'll never reach $100 a day. Option D. I need to trade more often. 5 trades a week isn't enough.
The correct answer is B. And this is probably the most important round of all, because this is exactly where most people break down. Not on a losing trade, not on a bad day, but on a quiet, normal, boring result that you feel is below your expectations. In option A, you're jumping between strategies. You haven't even given your current strategy a chance over a sample of 30 to 50 trades before you start looking for a new one. And that's going to turn into an endless cycle. In option C, you chose to increase your volume out of frustration. It seems like if I risk more, then I'll earn more. But in reality, you'll just blow through your deposit much faster. Option D is overtrading. More trades does not equal more profit. Most often, this means more commissions and more mistakes. And the truth is, that plus 30 a week is normal. It's a week where you made money, you didn't break the rules, and you kept your account. You'll have many weeks like that, and that's how you get a month with plus $2,000. And here we are at the final round. A whole month has passed, 20 trading days. Let's take a look at your trading results. 1,400. Not 2,000, not 3,000, but just $1,400. $70 a day on average. And it's not like the $100 we originally wanted to earn. 5 days you had no trades at all. 4 days you were in the red. And only 1 day were you able to reach your goal of exactly $100. On the 20th, the last day. And this is where the next question arises. Do you consider this a failure? Or is it a real and successful result? I'll tell you, it's a result because you made money, you didn't break a single rule, and you kept the account. And after 2 or 3 months like this, when your skills improve, when you start seeing setups more accurately, this number will definitely grow. And you don't even have to force the market. And the one who tried to squeeze out exactly $100 every day probably didn't even make it to the end of the month. So you're already in a winning situation. And since we've completed the quest, here's a bonus level for you, based on a true story. There's a guy with the nickname Wade. He's 19 years old. He hasn't taken a single course. He hasn't read a single book on trading. Before trading, he spent 4 years doing car chip tuning and earned about $800 a month. After all that, he took a $50,000 account on Upscale. He passed the challenge and started trading. Look at his win rate, between 29 and 47%. He is actually wrong significantly more often than he's right. But his average profit is 4 times larger than his average loss. In this story, he didn't try to earn $100 every day. He tried not to break his rules every day. $100 came as a result.
And just to be open, along the way, he had a day where he blew that very account because he sat down a trade in a bad headspace. And do you know what he did right then? He bought a new challenge, passed it in a month, and his next 3 payouts were in the amount of $30,000.
And this isn't a story about a genius, it's a story about a guy who understood the main thing. Distance is more important than speed, and the process is more important than the numbers. At this point, I can congratulate you because our quest is complete, and let's summarize. $100 a day. It's an absolutely real figure, but not for those who want it tomorrow or even today. It's really for those who are ready to make the right decisions for 20 days in a row. Or even more. Even when you're bored. Even when your results are sitting at 0. And even when you'll want to push to hit the norm, which of course you shouldn't do. Stop chasing the number. Start chasing the process. Every day is one right choice, then another one, and another. And in the end, that number, $100 a day, will come on its own. If you want to try following that same path, the link to Upscale will be in the description below. A challenge from $59 where you can trade crypto, forex, or commodities. And all of this can be in one account. And up to 90% of the profits will be yours. Please don't forget to subscribe, leave a big thumbs up, share your thoughts in a comment, and be sure to hit the bell icon. And I will see you at the top.